In the next few minutes, with these two videos and the free book instantly available below, I'm going to show you how to make more money with stocks more easily and with less work than I'm sure you ever thought possible. What's more, you'll see how to do this with much more safety than you're probably used to. And forget about being hunched over a computer for several hours a day. Look for the average investment to last 6 or 7 years, leaving you free to enjoy life the way you choose to enjoy it. Hello, I'm Sidney Tremaine, and I've been involved with stocks for 56 years, both professionally and privately. Come with me on an exciting journey that began with a best-selling book and a software program I designed almost 30 years ago. That program produced an average return of more than 22%, but I knew it could be better. A completely new book, available free on this website, demonstrates a much improved stock management system in detail. It works better than I had expected. But saying so is one thing. I want to give you absolute proof. Nothing is hidden, not even the things I might prefer to have swept under the rug. There are three essential tools: short-term highs and lows, and we'll get to those in a minute, trend lines, and stop-loss orders. The book explains in detail what each of these are and how they are used. Essentially, the system tries to track overall direction of a stock and to spot when that trend changes. To do that, we look for buyers or sellers to start to dominate. Short-term highs or lows are early clues. Here's an illustration of a part of a stock chart, and this is a short-term high. It is higher than both of the previous 2 weeks and the following 2 weeks. What that really illustrates is that buyers were overcome here by sellers, but eventually overcame the sellers, and the stock was able to continue upward. Stop-loss orders are orders to sell if a certain price is triggered. They are not used until a trend line is in place. Each vertical line on the charts we use represents all price activities in a single week. The top of the line shows the high that week and the bottom the low. Let's look closely at Boeing. The charts go back more than 40 years. There are 6 completed trades, and the average return over that period is a little below average, so no way can we be accused of favoritism. The minimum length of a bear market line, that's this one here, is 39 weeks, sloping down to touch 2 of the short-term highs. Once we give the program a starting point, the computer generates everything else. We start with a falling market. Since we don't recommend trading markets with short sales, we cannot taint the computer-generated results. As you can see, this line is far longer than 39 weeks. That's because our trend lines are unusual. In most systems, trend lines are allowed to accelerate only in the direction of the overall trend. Ours can be moved small distances in the opposite direction to compensate for what we think of as measurement errors. Without that rule, we would have bought Boeing halfway through the bear market, somewhere about here. Instead, we bought at 39 cents, adjusted for numerous stock splits, on January the 5th, 1970. To keep these videos short, let's use a second video to see what happened with this and other trades during the past 40 years. I look forward to seeing you in the next video now that we have the preliminaries out of the way.